Now, market participants have to start investing like women. That's the suggestion from a recent study by the Warwick Business School in the UK. It analysed behaviour and returns of 2,800 investors and found that women outperform men. Florbela Yates, head of Momentum Investment Consulting, joins me now to unpack this further. Florbela, very interesting insights coming out here, but let's start about the behavioural qualities displayed by women investors, which may be able to explain why their performance is superior.
Thank you for having me on the show. Well, I guess the difference is that a lot of men invest for the thrill of investing. They want to see how their money does. They try out to buy stock. It doesn't work. They buy something else. Women tend to rather invest for a particular outcome. And because of that, they tend to stay the course. And all the research shows that if you stay the course, you're more likely to get your investment objective. And in fact, in a recent study, looking at investments over 20 years, people who stayed the course over those 20 years, picked an investment strategy that was designed to meet their outcome, actually got twice the amount, double the amount of returns that investors did if they tried to time the market and missed just the top 25 days over those 20-year period.
That's very interesting, and I'm glad that you've mentioned the outcome-based investing very briefly there. But please elaborate on this philosophy.
So what outcome-based does is, very simply, it is designed to help investors decide what it is that they're saving for. So it could be for retirement, for a child's education, for an overseas holiday, whatever that outcome or that objective is. You then map the investment strategy to that. So if, for instance, you know, you're going overseas in 2 years' time, you've got no money saved, it's going to cost you 20,000 Rand. You work out how much you need to save either on a monthly basis or with a lump sum. And then you would target normally a CPI plus, or you want to outperform inflation, let's say by 4% per annum. And you put it into an investment that is diversified across different asset classes, and that is designed with the objective of getting you to that CPI plus 4 target, for example. So it aligns the investor's requirement or outcome to what the asset manager is then investing the money in on their behalf.
And we mentioned this a little bit earlier, but why is it so important to be invested for the longer term than it would be for shorter terms? And I mean, this would go beyond investing on the stock market and would probably filter into fund managing and the like.
Well, because none of us have a crystal ball. If we did, you and I would be sitting on some beach somewhere. We don't know when the markets are going to perform. That's the reality. What we do know is that markets do come with certain periods of volatility. And as long as you align the investment horizon that you're willing to stay invested for with where your outcome ultimately is taking you, it's better to then let the markets play out. You have the luxury of time. So if you have a period where markets do badly, or as you said, funds or other asset classes, you're not forced to sell because you've got the luxury of waiting a little bit longer. And all research shows that staying over the longer term, you actually generally tend to meet those performance objectives. It's chop and change that it becomes more difficult.
Yeah, and then very briefly, some tips for outcome-based investing that you might have for men, because it looks like women have that on lockdown.
So look, I don't want to generalize. It's not all men and not all women, but generally what we found works is define what you're trying to save for, and make sure that you have enough time on your side to try and get you there. If you've already got some amount of money saved, start with what you have. It's always better to start with a little bit of a pot of money. Then diversify. We don't know whether the market's going to do well or bonds are going to outperform. You may have some liquidity needs where you need to draw money in the short term. So put that into an income or cash bucket. Maybe you want to diversify by going offshore. So diversify, diversify, diversify. That'll get you about 80% of the way towards your outcome. Then within each asset class, try and work with a manager or an advisor that's going to work out the strategies that are most able to get you there. And then very important, partner with an advisor that understands your overall requirements, how much tax you're going to be paying so that you find the most optimal investment strategy. And then simple tips. If you haven't started saving, The best thing that you can do if you're a homeowner is to pay off your bond. Don't use that money for this overseas holiday. Rather put savings towards that. And make sure you stay for the investment term. Be disciplined so that you don't go off course. Try and remind yourself of what it is that you are saving for and why it's so important. And then make sure that it's invested with an appropriate asset manager where they understand what they're doing, they've got a good track record, and they really are able to stay the course.
Brilliant. Thank you so much for those insights. And we're not generalizing, but we do hope that the men of the world were listening to that particular conversation. I've been speaking to Florbela Yates, who's the head of Momentum Investment at Consulting.